Algorithmic trading. In this webinar, you will learn what is an algorithm, what is algorithmic trading, different types of algorithmic trading strategies, and its advantages and disadvantages. What is an algorithm? Let us start by defining what is an algorithm. An algorithm is a detailed series of instructions for carrying out an operation or solving a problem. Algorithm was originally born as part of mathematics, but is currently associated with computers and computer science. Although the word algorithm is strongly associated with technology and computers, in a non-technical approach, we use algorithms in everyday tasks, such as a recipe to bake a cake or a do-it-yourself handbook. Similarly, computers use algorithms to list the detailed instructions of how to carry out a certain operation. Elements of an algorithm? To create an algorithm, you need three main things: a problem that you want to solve or a task that you want to complete, a series of clear and consecutive steps that allow you to solve this problem or complete this task, and a method that allows you to measure the performance and quality of the end result. In simple words, a method that allows you to check if the steps that you have outlined were able to solve the initial problem or not. What is algorithmic trading? Algorithmic trading is also known as automated trading, black box trading, or algo trading. It is a method of executing trades with the use of mathematical formulas run by powerful computers. It is done using pre-programmed trading instructions that accounts for variables such as time, price, and volume. Algorithmic trading makes use of complex formulas combined with mathematical models and human oversight to buy and sell financial securities. Algorithmic traders often make use of high-frequency trading technology, which can enable them to make thousands of trades in a very short time. Algorithmic trading example. To showcase a simple example, let us suppose a trader follows this simple trading method. Buy 50 shares when the 50-day simple moving average crosses above the 200-day simple moving average, and sell 50 shares when the 50-day simple moving average crosses below the 200-day simple moving average. Using these two simple conditions, it is easy to write a computer program that will automatically monitor the stock price and the two moving averages and accordingly place the buy and sell orders when the defined conditions are met. The trader no longer needs to watch the chart and put in the orders manually. The algorithmic trading system automatically does it for him by correctly identifying the trading opportunities the moment they occur. Algorithmic trading strategies. Any algorithmic trading strategy requires an identified opportunity that is profitable in terms of improved earnings or cost reduction. The following are the most commonly used strategies: trend-following strategies, arbitrage strategies, index fund rebalancing, volume-weighted average price, VWAP, and time-weighted average price, TWAP strategies. Trend-following strategies. Trend-following strategies follow price trends using moving averages, channel breakouts, price level movements, and other related technical indicators. These are the easiest and simplest strategies to implement because these strategies do not rely on predictions or price forecasts. Trades are initiated based on the occurrence of desired trending traits, which are easy and straightforward to implement through algorithmic coding without getting into the complexity of predictive analysis. The previously mentioned example of the 50-day and 200-day moving averages is a simple yet very popular trend-following strategy. Arbitrage strategies. Buying a dual-listed stock at a lower price in one market and simultaneously selling it at a higher price in another market offers the price differential as risk-free profit or arbitrage. The same operation can be replicated for stocks versus futures contracts, as price differentials do exist between one market and another from time to time. Implementing an algorithm to swiftly identify such price differentials and instantly place the orders allows for profitable opportunities in an efficient manner. Index fund rebalancing. To explain the index fund rebalancing strategy, we first have to explain what is an index fund. An index fund, also known as index tracker fund, is a mutual fund or exchange-traded fund designed to follow certain preset rules so that it can track a specific basket of underlying investments. Tracking can be achieved by trying to hold all the securities in the index in the same proportions as the index. Other methods include statistically sampling the market and holding representative securities only. Many index funds rely on computer models with little or no human input in the decision as to which securities are purchased or sold, and are thus subject to a form of passive management. The main advantage of index funds for investors is they don't require a lot of time to manage, as the investors don't have to spend time analyzing various stocks or stock portfolios. Index fund rebalancing. Index funds have defined periods of rebalancing to bring their holdings to par with their respective benchmark indices. This creates profitable opportunities for algorithmic traders who capitalize on expected trades that offer 20 to 80 basis points profits, depending on the number of stocks in the index fund, just before the rebalancing process. Such trades are initiated via algorithmic trading systems for timely execution and best prices. Volume-weighted average price, VWAP. Volume-weighted average price strategy breaks up a large order and releases dynamically determined smaller chunks of the order to market using stock-specific historical volume profiles. The aim is to execute the order close to the volume-weighted average price. Time-weighted average price, TWAP. Time-weighted average price strategy breaks up a large order and releases dynamically determined smaller chunks of the order to the market using evenly divided time slots between a start and end time. The aim is to execute the order close to the average price between the start and end times, thereby minimizing market impact of instantly executing a large order. Requirements for algorithmic trading. In order to implement an algorithmic trading strategy, the following technical requirements are needed. Computer programming knowledge to the program that required trading strategy, hired programmers or pre-made trading software. Network connectivity and access to trading platforms for placing the orders. Access to market data feeds that will be monitored by the algorithm for signal generation. The ability and infrastructure to backtest the system once it's built and before it goes live on real market conditions. And available historical data for backtesting, depending on the complexity of rules implemented in the algorithm. The term backtesting refers to testing a trading system on historical data to see how it would have performed during that time period. Most of today's trading platforms have robust backtesting capabilities, and traders can quickly test their strategies without risking real money. Backtesting can be used to evaluate simple ideas, such as how a moving average crossover system would perform, or complex systems with a variety of inputs and triggers. A strategy can be coded using the proprietary language of the trading platform, and then certain user-defined input variables can be integrated that will allow testing for optimization. For example, a simple moving average crossover system could include inputs for the period of the two averages used in the system, and then back-tested to determine which duration would have performed the best on the historical data. Also known as paper trading, forward performance testing provides another set of data on which to evaluate the trading strategy. Forward performance testing is a simulation of actual trading and involves applying the strategy in a live market. All trades are executed on paper only, that is, no actual trades are taken, and documented for evaluation purposes. Many brokers provide simulated trading accounts where traders can place trades without risking real money. If the strategy shows positive results with good correlation between in-sample, out-of-sample, and forward performance testing, it may be ready to be applied on the live market conditions with real money. Algorithmic trading provides the following benefits: trades being executed at the best possible prices, instant and accurate placement of trade orders, another reason for execution at the exact desired levels, multiple market conditions being simultaneously and automatically checked, reduced risk of emotional and psychological errors, as well as errors in order placement, the ability of strategy backtesting before live implementation. Although there are many benefits to algorithmic trading, there are some downsides as well. One of the biggest disadvantages of algorithmic trading is the technical sufficiency and the resources required. The required know-how to program in specific program languages, which can take quite a while to learn. Another disadvantage of algorithmic trading is the lack of control that comes with automation. Controlling the losses can go out of hand sometimes if the program runs in an undesired way. Last but not least, programs need to be continuously tested for errors and technical glitches, debugged and optimized every now and then to sustain a good performance. Thank you for watching.